In this week's video, we'll cover the balancing act between new bearish cracks and ongoing be patient facts. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. With the markets jumping up and down this year like a yo-yo within a range, the term frustration has been used a lot. It's important to note, and we're not noting this because it's an excuse, it's just a fact. The last 28 months, not just this year, the last 28 months, we've seen things that we've never seen in our lifetime. Some of the things that have taken place haven't occurred since 1900. Here are a few examples of some of the unprecedented or extremely rare market events that we've seen that have undoubtedly been helped along by the Fed and their zero interest rate policy. Clients will remember the excellent analysis from Dana Lyons, 1950 to 2012. The stock market made a sharp V bottom once every 1.6 years. So note, this is a 62-year period where we would see a V bottom once every 1.6 years. Between March of 2013 and December of 2014, a V bottom occurred once every 2.1 months. Extremely rare. 2015, we've moved into another extremely rare and quite a bit different period. The S&P 500 did something in the first half of 2015 that has not done since 1904. The S&P 500 posted 2 consecutive back-to-back quarters of 0% gains. In fact, this has happened only one other time in the past 125 years. It's a pretty incredible stat. It happened twice in 125 years. On Thursday of this week, the Dow Jones Industrial Average swung to a negative year-to-date return for the unbelievable 21st time within calendar year 2015. Something like that has never happened before. To put a visual context around it, March of 2013, V-bottoms occur at a frequency unlike anything seen over the previous 62 years. And then we go into another period where we have comments like, no other year has been so fickle. Extremely rare, and quite a bit different. Since there's no magical indicator, time frame, or ratio, the market model diversifies. This is one set of daily moving averages. In this instance, the only questions the model asks has nothing to do with slopes. It's just, is blue above red, is blue above green, is blue above pink, and is blue above purple. This is calendar year 2015, and in the videos you've heard me say several times, the hard data and the trends are allowing us to be patient. Volatility to ignore, it hangs in there. Volatility to ignore, it hangs in there. Volatility to ignore. In fact, a week ago, this is starting to turn back up. All of the moving averages are turning back up, and this is an improving look. We're using these charts as an example of observable changes. This is by no means what has driven our decisions. It's part of it, and again, it's an example of an observable shift that's taken place. Last Friday, the answers to all the questions were yes. Fast forward a week, the answers have shifted all to no. This is observable. We can see it. Blue below all of these moving averages is something different. It doesn't mean run for the exits. It just tells us that the probability of bad things happening as of the close on Friday, July 24th are higher than they were at any other time in 2015. If we zoom in, we can see it a little better. Again, this is just one example of things that we've seen last week. Blue is above all of them this week below. The CCM market model is not a binary model. We're not all in or all out. What we do is we say, based on the evidence that we have in hand, hard evidence that we can see and measure, are we allocated properly? If yes, leave it alone. If no, make an incremental adjustment. This is another set of daily moving averages used by the market model. There's nothing particularly magical about them. They're helpful. Blue is above here. You can see we get a bearish moving average crossover. The bullish period prior to the dot-com bust rolling over is quite a bit different than the bear market. This looks different than this. How do the exact same moving averages look today? If you were around when the dot-com bubble burst, and I was, you'll remember that the bear market really didn't start to roll over in earnest until late 2000 and in 2001. The model in this instance is not looking at slopes. It's just asking, is blue above red? Is blue above green? Is blue above pink? You can see here the answers were yes, here they're no, and then very bad things happened. This is try to be patient evidence. We have plenty of it. It's a mixed bag. Things still look good. They just don't look as good as they did even a week ago, and thus the reason why, by rule, we had to take an incremental step away. If we examine both bullish and bearish evidence, it helps us keep a flexible, unbiased, and open mind. Remember, we talked about our rare back-to-back quarters with 0% gains in the S&P 500. Last time it happened, 1904. What happened next? After mid-year 1904, stocks went up 43% over the next 2 quarters. In fact, this calculator shows that if we invested in January of 1904 and went nowhere for the first 2 quarters of the year and held until January of 1906, our total return in the Dow Jones Industrial Average would have been over 100%. Earlier in the video, we noted one of the odd things that's happened year to date is that the Dow has swung between profit and loss 21 times. That's an all-time record. Have there been similar periods? Yes. Similar things happened in 1934 and 1994. Were those good periods to sprint for the exits or stay invested? 1935, the Dow gained 38%. 1936, it gained 25%. 1994 was cited as being similar to 2015. Was that a good time to sprint for the exits or stick with your discipline? Answer, discipline. 37% move after the frustrating period ended. When the market makes all-time highs, is that bearish? In isolation, no. S&P 500, 1990 to 2000, a 10-year period. All-time highs occur frequently, and it is not uncommon. How about weakness in the transportation index or that tepid market breadth? Showstoppers? Let's look at a historical example, and let's assume that when the transportation index did certain things, we use that as a guide to get out of the stock market. One thing could have been the break of this trend line, or step 1. 2, we could have gotten out of the stock market when the transports made a discernible lower high, or we could have waited until the transports confirmed, probabilistically, a bearish trend change at step 3 with a lower low. Would this have been helpful? The answer is a definitive no. In fact, it would have been extremely harmful. These are the exact same dates, step 1, step 2, step 3. If I got out at step 1, I would have missed a 40% gain in the S&P 500, and I would have been wrong for 676 calendar days. How about market breadth? Remember last week, if we exited the S&P 500 when new highs, new lows rolled over here, we would have missed an 872-point gain in the S&P 500 and we would have been wrong for a period that corresponds to being wrong until the spring of 2017. Market breadth and the transports are both useful. However, there are much, much better things to use as timing tools. This week on Short Takes, we did a sentiment analysis. How does that look now? When we did the analysis on July 20th, the CNN Money Fear Greed Index was at a fear level of 38. On Friday, investors have become even more fearful. They've moved into extreme fear territory, closing at 9. One of the reasons might be recency bias. If you want to see this analysis in detail, you can Google this title here. 1987, 2003, and 2009 were the 3 best times to invest in the past 30 years or so, and they have things in common with 2015. You'll remember in that analysis last week, we tied an investor sentiment reading not seen since after the 1987 stock market crash. This week, we broke the record by staying above 40% in the neutral area on the AAII sentiment survey. Remember some of the similarities to 2015. 1934, the stock market went sideways, then it went up. 1994, the stock market went sideways, then it went up. Anything similar in 2015? You bet. Gains, sideways consolidation, resistance. Resistance, what once was resistance, may now act as support. We're approaching that support line again. This is part of a fractal analysis. You can find it by Googling this title here. Heading into Friday's session, we had 7 guideposts identified. 6 of them were taken out in Friday's session, which is part of the observable evidence. Is there any reason for hope? Yes. 61.8% retracement is at 2077. We held in that general area. That was the low, 2077. We closed at 2079. So this is a mixed bag as well. The model is not binary. We have observable deterioration, but we also have some reason to be patient and hold some longs and remain flexible and open-minded. Another reason to remain open-minded about all outcomes, we have 3 big events next week. Monday, durable goods. Fed meeting Wednesday, GDP Thursday. Some of the weakness may turn out to be a blessing in disguise for us that allowed us to cut some of our weaker sisters. This is basically foreign or global stocks relative to the S&P 500 here. We had a bullish breakout. What once was resistance in the ratio may now act as support. This is a week ago today on July 17th. There was reason mathematically for patience in the model and support-wise. If we fast forward, we see another piece of observable evidence. This is now the same chart as of the close on July 24th. Support on a weekly closing basis for the ratio did not hold. We're below it. Bad news is we had some dogs in our portfolio. The good news is we've weeded them out, and if the market bounces and responds to all of the bullish possibilities, which it may or may not, nothing says that we can't redeploy that cash quickly into better ideas. It's important to note that evidence in terms of what may happen is not what drives the model. What is happening is what drives the model. Price has yet to confirm any bullish analysis, nor has it confirmed any bearish analysis. How do we know that? We're still in the range. We've not closed above 2134 on the top end of the range, and we've not closed yet below 2039. Price has to confirm any potentially bullish evidence or bearish evidence. Price will guide us. Remember, one of the common tenets of our fractal analysis was the market needs to consolidate its gains. Fractal analysis also told us to be open to both bullish and bearish outcomes. We'll head into next week with a flexible, unbiased, and open mind. Maximum flexibility is always important. In our approach, we monitor and adjust rather than anticipate and hope. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.